Hey everyone, welcome to the first annual end of year mailbag. I'm Adam Bergman, tax attorney and founder of IRA Financial, and I want to wish everyone a happy, healthy new year. We're going to have some fun today. Probably spend 30, 40 minutes going through some end of year mailbag questions. And a bunch of these questions are from clients, non-clients, even employees of IRA Financial. So I kind of gathered what I felt were the 20 or 30 best questions that addressed some of the key issues that clients and potential clients have asked over the year. And I want to chat about them. And obviously, feel free to submit any questions you have. The more interaction, the better, more fun this whole YouTube Live episode will be. So again, thank you for sticking with me all year. Really appreciate it. It was a lot of fun. It's been a crazy year, notwithstanding COVID, but the self-directed IRA industry, we saw huge growth from cryptos, from alternative assets, pre-IPOs. Then towards the end of the year, we got hit with some tsunami of legislation in DC that we thankfully were able to push back. The two provisions that were the most upsetting were the accredited investor and the 10% provision on investments, which would prohibit IRAs from investing in any accredited investor investments or any investment where the IRA owner owned more than 10%. Thankfully, those provisions have been removed from the Build Back Better bill, which is presently in a state of comatose. It will probably be resurrected next year in some form or fashion, assuming they can get Senator Manchin on board. But the thought is that that will happen. Not sure what will occur. Some of the other IRA provisions in there, namely the 10 million cap on retirement accounts, the prohibition on backdoor Roth IRAs and mega backdoor Roth 401ks, which still remain in the bill, the statute of limitation increase of 3 to 6 years for IRAs, and then the elimination of pre-tax to Roth conversion starting in 2031. We'll see what happens next year. But I spent enough time on legislation over the last 3-4 months. I thought we'd have some fun with this end of year mailbag episode. So let me just start from the top. So here's a question. I'm not going to even mention names or email addresses. I just want to get right to the question. So I want to set up a solo 401k before 12/31. Will I have time to do it? Employer contributions for 2021. So the answer is yes. We're getting close, right? It's 12/29. But thanks to our technology and our app, you can set up a solo 401k in a day. And depending on how your company is set up, you should have the opportunity to make employee deferral contributions. The rules work as follows. If you're a single member LLC, sole proprietor, you can do employee deferrals, which is $19,500 or $26,000 in 2021, up until you file your tax return. Okay, so you got plenty of time. Employer contributions, the 20 or 25%, 20% if you're a single member LLC or sole proprietor, that's 20% of your comp, or 25% if you're a W-2. That can always be done up until you file your return. So you got time. Now, if you're a W-2, because you have a C or S Corp, or you get guaranteed payments from a partnership, those employee deferrals technically need to be done by 12/31. Now, you can always elect to do so, write a check 12/31, and then deposit it a few days later. But the idea is the election needs to get done. So the answer is yes, you can set up the plan quick. If you're a single member LLC sole proprietor, as long as your plan's set up in 12/31, you're good to go. And you can make those contributions in 2022 for the 2021 taxable year. If you're a W-2, you want to get cracking as soon as possible. If you don't set it up in time and you set up in 2022, all you're going to be able to do is employer contributions, or technically mega backdoor, right? $58,000 if you're under 50, $64,500 if you're over 50, dollar for dollar. But you want to get that plan in place. The next question, if I qualify for a Roth IRA because I make too much money, or I don't qualify, for a Roth IRA because I make too much money, can I still do Roth contributions for my 401k? So the answer is yes. When you do contributions to a 401k, pre-tax or Roth on the employee deferral side, there are no income limitations. Okay, so even if you make $100 million, you can still do the 19.5 or 26,000 in Roth. For Roth IRAs, The income limitations for 2021 is $208,000 if you're married, filed jointly, $214,000 in 2022. So if you're under that, you can technically still do Roth contributions. You can always do the backdoor Roth IRA for 2021, which will let someone who makes over that 208 threshold make an after-tax IRA contribution and then immediately convert it to Roth. As I mentioned, the Build Back Better Act has a provision in there to eliminate backdoor Roth IRAs and mega backdoor Roth 401ks in 2022, although we'll see where that goes since the bill is presently in a state of comatose or coma. So we'll see. But Roth contributions have no income limitations. Here's another question from Vernon. I'll flip back and forth from live questions to questions that I have in queue. I'm a new customer. If I came to Miami Beach area, would you meet with me for lunch? I will buy. Sure, why not, Vernon? If you're buying, my pleasure. It's like I said, I'll open this up to the world. If you're a client, or even if you're not a client, if you want to reach me, I'm happy to talk to anyone, for a couple minutes, generally 10, 15 minutes. I can give anyone. I'm not the Pope. I'm readily available, especially if you're a client of IRA Financial. So you can reach out on social media or email at info@IRA Financial, and you can say, question for Adam. It will get to me, I promise. I'm happy to answer your questions if we need to go through detail. Again, even if you're not a client, I'm happy to give you a few minutes of my time to explain a question. It's what my passion is. It's not just about accounts and money. I'm happy to educate people. So, my pleasure. Hi, Kara. Okay, next question. If I pass, not married, and then my sister is a beneficiary on my solo 401k, what happens to the real estate asset? So the real estate stays in the plan, and assuming you're self-employed, let's say, and you're not married and you pass. So that means your business generally, I assume, will probably stop operating if you're the sole proprietor, or even if it's a single member LLC. Technically, the LLC doesn't die, but the business likely will stop operating because you're gone. And then what happens? So your sister is the beneficiary. All she would need to do is close the plan and roll that into an IRA tax-free, and she would then be able to take those assets out over a 10-year period as an inherited IRA. What happens to the real estate assets from a solo 401k when I pass? Nothing. It stays in the plan, and it's up to the beneficiary what he or she will do with it. If the business is still operational, let's say you and your sister are partners in a restaurant, and it's just you two, no full-time employees, then the restaurant could stay in business and you can keep the plan. The account will just move to your sister. So not a problem at all. Do I need a beneficiary form for my solo 401k? You should. Yes, absolutely. Where do you find one? We have one on our app. You can find one. It's easy to use. If you have questions, let us know. You basically need to provide a primary and contingent. If you are choosing a primary that's not a spouse, generally you're going to need the consent of the spouse to do so, especially in community property states. And you should keep it somewhere safe because, God forbid, when you pass, you want to make sure that beneficiary form is easily traceable and easily able to be located. And you generally want to make sure your primary beneficiary matches up with your will. So if you are married and you have your spouse as your primary beneficiary for your plan, you generally want to have your primary beneficiary as the primary beneficiary for the majority of your assets in your will. It's just going to make things easier. Okay, Chris, moving on to some live questions. In the process of getting my account set up for crypto, awesome. I was looking at another company, but were advised I was limited to the crypto I would trade with them versus the platform they use. Are there limitations with Gemini or all the assets Gemini allow trading on available? Yeah, whatever Gemini offers, Chris, you can use. Okay, we don't make money on trades. You can even do the Gemini earn. So if you want to earn some interest on the assets you own in Gemini, you can do that. Currently, I'm going to focus on this in some fashion in the next few minutes, but before a case called the McNulty case, which just came out a couple weeks ago, or about a month ago actually now, we allowed our clients to pull the cryptos off the exchange and hold them in a cold wallet. However, that case made us pause because there's language in that case that says an IRA owner should not personally possess an asset of the IRA. The case was focused on gold and gold coins, although you can argue that holding cryptos, digital asset on a cold wallet, in your possession could violate McNulty. So we're in the process of working with our crypto developers to devise a multi-signature wallet solution, which will allow you to have a cold wallet at home, which will permit you to move cryptos off Gemini and hold them in a cold wallet without violating McNulty. So that's in work. We're testing that. We'll buy the ledger or whatever wallet you want. We'll ship it to you using IRA funds. And then we'll have a dual signature where we have some control. You have control because you can hold the digital wallet or the hard wallet, and then you'll just need our consent to move it. It's not perfect, right? Unfortunately, you still need our consent, but we need to satisfy the McNulty case now, and it's just the way it is. So we're working on a solution. Again, if it was up to me, I would give the IRA owners ultimate control to your asset. If you get caught and do a prohibited transaction, that's your issue, not mine. But the issue is, as an IRA custodian, we're regulated. We need to make sure we're in full compliance and our clients are in compliance with the IRS rules. Okay, Kara, I'm coming back to you. I have a solo K with you since 15. Great. I closed all my IRAs 2 weeks ago. They would not deposit the rollover directly into my solo K, but only into a personal account. That's okay. I'm not sure why. So you can do an indirect rollover. You can do that once every 12 months, Kara. So there's no withholding when you move an IRA to a personal account. Just make sure you haven't done one of these indirect rollovers 12 months. And then you have 60 days, Kara, to move the money from your IRA to a 401k. So not the end of the world. We can help you with that. Just work with us so we can code everything properly for you. You'll have 60 days when you get receipt of or cash in your account to move it into your solo K. Okay, so just take note of that. And the indirect rollover can only occur once every 12 months. A direct rollover can be done unlimited. Direct rollovers are 401ks to IRAs. You can do those 1,000 times a day. Or transfers. IRAs to IRAs can be done unlimited. Indirect, where the money goes to you and then to a retirement account, can only be done once every 12 months. And you have 60 days once you have control of that cash or that in-kind asset to then roll it back into another retirement account. If you get cash in, you got to send cash out. If you take an in-kind distribution of cryptos, let's say, or real estate, you got to contribute that asset back. You can't just contribute the cash and take the cash out and contribute in Bitcoin. If you take cash out, put cash back in. Ford said that would have to do a 5498 form. No, they would do the 5498. 401ks don't do 5498. But what will happen is once you roll it into a 401k, you'll file a 5500, which will then show the rollover. Okay, so we'll assist you with that, Kara. They're incorrect. 5498s are only filed by IRAs, not 401ks. If they rolled it into an IRA, so what you can do, Kara, too, is set up an IRA with us, and then just roll the money from the former custodian to IRA Financial, tax-free transfer, and then we'll file that 5498 for the IRA. And then from the IRA, you can do a direct rollover to a 401k if you want to have some cleaner accounting reporting cycle. But otherwise, you can do an in-kind distribution. You just have 60 days to get it into a retirement account. And remember, you can only do an in-kind distribution once every 12 months. Or you can just roll it into an IRA with us. We'll do the 5498, and then we'll send it to the 401k with tax-free. Do I have 60 days to move from a personal to solo? Yes, you do. Chris, thank you. You're welcome, Chris. I have an IRA used for tax sale investing. Can I use same IRA for crypto investing? Mr. MC, 100% you can. Just go on our app, open a Gemini account. There's no additional fee since you already have an IRA with us. And you can start buying cryptos on the Gemini platform, which is awesome. So there you go. Again, if you have more questions, send them in. Let me revert back to some of the questions I have in queue. Me and my brother are owners of an S-Corp. We'll set up one plan, one bank account, or are you recommending separate plans with separate bank account? Pros and cons. So a 401k is set up by the business. So Apple, which has 40, 50,000 employees, has one plan. Okay. It has maybe 40 or 50,000 sub-accounts, one for Joe, one for Jane, one for Ken, one for Larry, one for Beth, but it's one plan. So what I would say in this question is you set up one plan, had two sub-accounts, one for you, one for your brother. This way you can be co-trustees, but you'll have control over each of your accounts. You can also do what's called a pooled account, but there's a little more risk, right? Because now all your assets are combined, especially if you're doing alternative assets and there's valuation issues and distributions, it gets more cumbersome. So I like the sub-account solution a lot better. We're very interested in maximizing mega backdoor Roth 401k if available in 2022. Well, as I mentioned, I hope so. My brother may not be interested in maximizing, but I want to maximize the 64,500. We both make over 100K. Can I put 64 in and he could decide to put less? So yes, technically, because it's a solo 401k, there's not ERISA testing. Now, ERISA testing involves certain plan testing, i.e. top heavy, to make sure that the highly compensated employees aren't doing too much and more than the lower compensated employees. And then there's something called the deferral percentage and a contribution percentage. So in this case, yes, you can do the mega full and your brother may not, because it's a non-ERISA testing. You're not going to fail the top heavy or the ACP test. So to answer your question, yes, that's an option. If I have an IRA and I'm also self-employed and want to do real estate, should I set up a solo? Honestly, the answer is yes. I said this before and I'll say it again. If I could, even though the name of my company is IRA Financial, I would put every client in a solo 401k if they satisfy it. Why? Because with a solo K, you can make high contributions. It's 58 or 64.5 in 2021. An IRA is 6 or 7,000. Yes, if you have a SEP, it can be 58,000, but the SEP is no catch-up, right? The solo does 58 to 64.5 if you're over 50. SEP can't do Roth, it's just pre-tax. No loan on the SEP. Solo, you can borrow 50,000 or 50% of your account value, whatever's less. If you do real estate and you want to use leverage, solo 401k has an exemption from the UBTI, the Unrelated Business Taxable Income Tax. No such exemptions with SEPs. So for all those reasons, yes, I would do a solo K over an IRA. The only time you can't is if you have a Roth IRA, you can't roll a Roth IRA into a 401k. You can roll a Roth 401k to a 401k, but you can't roll a Roth IRA into a 401k. That is expected to change. Last year, we heard rumblings, or chatter, I should say, positive chatter, that was going to be in Secure Act 2.0, which we thought was going to be released this year, but with all the craziness that happened in DC with infrastructure and Build Back Better, that's probably going to be pushed till 2022, although maybe not because of midterms. We'll have to see. If there's bipartisan consensus and it's not super controversial, then a Secure Act 2.0 could pass in 2022, but anything controversial I don't think passes because of midterms. And I think both Democrats and Republicans are going to keep their head down this year, focus on what they've done, and try to get elected or reelected. So I'm not sure you're going to see a lot of controversial legislation. I have an IRA with IRA Financial. Can I use county tax assessment as my value for valuation? So yeah, it's valuation time. We've gotten thousands of valuations in. There's still like 10,000 more we're waiting on, maybe more, I should say, for IRAs. But valuations are due next month. Why do we need valuations? Because as an IRA custodian, we're required to provide the IRS with a valuation of your IRA each year. That's on a Form 5498, as I talked about in a previous question with Kara. So we need you guys to provide us the value. It's a self-directed account, so we don't know what it's worth. We see the cash in your account. We know what you hold, but it's not our job to value the real estate or the investment asset or the private placement. That's your job. So if you're not taking a required minimum distribution because you're under the age of 72, or you're not taking a in-kind taxable distribution of an asset like real estate or cryptos, then you want to give us a fair market value, but you don't need to go overboard and go crazy on making it super exact and spending lots of money. Why? Because it's not a taxable event. Right? If you're my age, if you're 46 and you have cryptos, that's easy to know what the value is as of 12/31. But I also own real estate. I also own private placements, hedge fund investment. Those investments are more difficult to value. And in some cases, you're not going to get an accurate or precise valuation by the time we require your valuation to be sent back in, which is generally by the end of January. So what do? Well, you speak to the promoter, you try to get, or the partner, general partner in the fund, you try to get them to provide you a valuation. Otherwise, in real estate, you can use a county tax assessment or truly something that's independent. I have some clients that will just use the valuation from the year before, especially if you invested in private businesses or private equity or hedge funds and you have not received an updated value. That's probably the best thing you're going to be able to do. So yes, you can use a county tax assessment. Now, if you are over the age of 72 and have to take RMDs and or you want to take an in-kind asset as a distribution, then you want to be precise. In fact, we're going to require you to have an independent person sign off, whether it's an accountant or a real estate agent or some professional, to attest to that value. Obviously, that's more crucial, way more vital that valuation is accurate because it's a taxable event. So just be cautious. But generally for real estate, it's not as complicated as an investment fund or a private placement into a private business. Let me go back to you, Kara, concerning buying gold and silver in a solo K. Can it be kept in a bank deposit box at the bank with a solo 401k? So before McNulty, I'd say buyer beware, be careful, it's super risky. McNulty case, the facts of McNulty was this couple McNulty, they had gold coins, they held them at home in a safe. They got audited, they lost. The IRS was clear, you cannot personally possess gold coins, IRA assets. So what about a bank, a safe deposit box? The issue is you may argue you're not personally possessing it because it's not in your hands, right? It's not in your house. But honestly, based off the language of McNulty, you have constructive control. You have the key. That key's in your hand, right? You can open it or close the safe anytime you want. You can pull the coins out. So after McNulty, I'd say no. Do not use a safe deposit box. Send it to a depository where you need to have that depository hold it for safekeeping. They're insured, licensed, regulated. There's a few we use that are really reputable. Been working with for 10 plus years. They do a great job, not expensive. So I would 100% recommend you do not hold gold or coins in a safe deposit box, especially not in your home. Safe deposit box is maybe less risky than safe in your home, but still based off the personal possession, I think the idea is that you have control, right? You control that asset. By having the key to the safe deposit box in your pocket, you have control. The IRA custodian, IRA Financial, has no control over that asset. Whereas real estate, you may hold the deed, but you can't just sell the real estate and take the money and buy yourself a car, right? There's a transaction roadmap that has to occur. Gold, digital assets like crypto, if you have control, there's a greater risk from the IRS's standpoint that you could have dominion over that asset and really turn that into a marketable asset. So I would be cautious. Okay, Mr. NC, I purchased lots on a tax sale for $500. Lots worth $5,000. Do I need to show the $500 or the $5,000 in valuation? You need to show the value. So if you paid $500, you got to show the value as of 12/31. Doesn't matter what you paid for it; it's what the value is. Can a client pay IRA Financial's annual fees with personal credit card? Technically, you can pay admin fees for an IRA with personal funds. Okay. In fact, before the 2017 tax bill, you were able to get a personal deduction if you itemize for IRA admin. So yeah, you can do that. Okay, let's go to some other questions. I have a business with 3 employees and have a separate business that is totally independent, that I'm the sole owner and employee. Can I set up a solo K for my sole proprietor without having to offer benefits to my employees in the other business? So this is a great question because this brings in to bear the control group rules. So the control group rules were put in the code, presented as a way to protect employees. The idea is that, hey, if you're a business owner and you want to have a 401k for yourself, then you should offer benefits to your employees. Okay, and again, an employee is someone who works more than 1,000 hours or based off the criteria in your plan document. So there are certain rules that if you own more than 80% of 2 businesses, even if they're unrelated, one has employees, one doesn't, if you set up a plan for yourself as the sole proprietor, you have to offer benefits to your full-time employees. The IRS treats those two businesses as one business under the control group rules. Now, even if you own 80%, if there's common ownership or attribution based off ownership of spouses or kids under the affiliated service or attribution rules, even if you're under 80%, you may be considered one business. And then there's also a third layer, which talks about management services, where even if the businesses are unrelated, but there's some cross-management services and some cross-ownership, you could fail the control group rules. So anytime you have two or more businesses and there's some cross-ownership, talk to a tax expert before setting up a 401k. You can talk to IRA Financial. I own two pension companies called Pension Investors that have been in business since the 1970s that have thousands of 401ks and defined benefit plans. They have significant expertise in the control group rules because that's what they entangle many times a week because that is the type of questions that arise when people want to set up 401ks. A lot of business owners have multiple businesses. And in some cases, the business owner may have their own business with their spouse where they just kind of have some management services and fee income come in, but they also have businesses with employees. And you want to make sure if you set up a solo K for your side business, you're not violating the control group rules and then creating whole lots of heartache for you from an IRS standpoint. So definitely, if there's cross ownership, talk to a tax advisor. Can you explain why the McNulty case will impact my ability to hold cryptos at Gemini at a cold wallet in my IRA? So I talked about this previously. Again, the McNulty case, just quick summary of facts. The McNultys, back in the 2015 or so, they were poorly advised and they decided to buy gold coins in their IRA LLC, and they kept them in their home. So clearly, if you looked at 408M, which is the provision that deals with physical possession of precious metals, it's clear. I mean, literally, if I could read it, it's clear as day. It says the metals need to be held in the physical possession of a trustee. And if you go through the definition of trustee, it's clear it's a bank or depository. Clearly not your home. The McNultys tried to get cute and said, well, the physical possession seems to only apply to bullion and may not apply to coins. Unfortunately, American Eagles are bullion coins, so even though they're coins, they're treated as bullion. Now, some other coins that are not bullion, an argument was attempted to be made that, hey, the physical possession requirement would not apply to coins. Now, clearly that was not the intent of the provision. Yes, the provision under 408M is poorly drafted, but clearly the IRS wanted the physical possession threshold to apply to coins and metals. So they lost the case. Unfortunately, it should have been a very uninspiring case. Should have been a 2-page opinion, right? You violated 408M, bang, you're done. Unfortunately, the tax court went into significant detail on the idea of personal possession of an asset. And basically, now that there's language on record, there's case precedent that can be argued that you cannot personally possess an IRA asset. Now, for most IRA assets, McNulty case is not material at all, right? If you own real estate, investment funds, stocks, anything intangible other than cryptos, obviously, and there's case that's clear, you can hold a stock certificate, you can hold deed, you can hold notes, you can hold investment fund documentation in the name of your IRA that would not trigger a prohibited transaction. Because you own a stock certificate and hold the paper, or you hold the paper of a deed, or you hold the paper of a note, or you hold the paper of a subscription agreement, clearly you're not in personal possession of the hedge fund investment or the real estate down the street. Obvious, right? And there's case law that backs it up. But cryptos, yes, it's a newer asset. It's been around 10 years. It's digital. It's intangible. But technically, you can touch it and have some ownership control over it through a cold wallet, right? If you hold Bitcoin or any crypto on an exchange like Gemini, it's like trading stocks. You have ownership or management of it. I shouldn't say ownership because the ownership's with the IRA. You have management over it. You can day trade the stock or the cryptos, but you can't do anything with it. You can't take the stock and buy a slice of pizza or buy yourself a Porsche with it, right? It's on the exchange. But when you pull gold off and hold it personally, or if you pull cryptos off an exchange and hold it in a cold wallet, now it becomes something that couldn't be used in a marketable transaction. It can be used as part of a commodity type transaction. You can trade the gold for a Rolex watch. You can trade the crypto for a car. And that's when the IRS gets concerned. So other than cryptos, I don't see McNulty case having much significance or having much of an impact in terms of how one goes about investing in self-directed retirement accounts or self-directed retirement investments. But for cryptos, yes, it changes things. After McNulty, I do not suggest people hold cryptos in a cold wallet yet. We're working on a solution that will be ready in the next couple of weeks where through a multi-signature wallet, as I mentioned, you'll have ownership with IRA Financial. So IRA Financial will have continued custody of that asset. You will need our consent to move it if you want to do DeFi trading or you want to move it back to an exchange, but at least you can hold it at your home. So you'll have more control and hopefully some more comfort in terms of fraud, hack protection. But McNulty definitely changes things when it comes to cryptos. Okay, another question from Kara. Any issues with buying tax lien certificates in a solo? Same as real estate. Yeah, no issues at all. Again, the certificate, piece of paper, like owning a stock certificate, clearly, the tax lien's not a marketable asset. It's just paper that represents the ownership. David, which brokerage companies are easy to work with, least expensive to open up a brokerage account for a solo? So guess what, David? We're going to announce our partnership with Fidelity in the coming months, where initially you'll be able to do robo investments with Fidelity for free. We will then unlock equity trading for free on our app. That will occur hopefully in the second quarter of 2022. But for now, TD is really good. They have accounts for self-directed IRA LCs where it's a specific account for an IRA LC, so it just makes onboarding easier. But otherwise, anywhere now, Fidelity, Schwab, TD, they'll all offer you pretty much free commission trading. Good platform, so I don't think you can go wrong. TD is really good for self-directed IRAs. Solo Ks, I have a lot of clients, just Schwab, Fidelity, TD. I think those are probably your best bet. Do you think the accredited investor and 10% ownership provisions from the House bill that got removed from the BBB will come back? No, I don't think they'll come back. I think the Democrats, even Senator Wyden, saw that there's just not a lot of consensus for this. There's no momentum. They got tons of pushback from the investment community. Those provisions are dead. They're not coming back for probably ever. I think the idea of using retirement funds to pay for legislation is not a great vote-winning plan. So I think you're going to see even the most progressives kind of push away from that. Taxing the rich is in, and that's something that will continue. That's just the way our tax system has worked since the onset, right? It's a graduated tax system. People that make the most money pay the highest amount of taxes. That's not going away. But taxing people's retirement funds and forcing distributions, just don't see a lot of interest in continuing to do that. Okay, I have a self-directed Roth IRA with you, and it owns a condo on the beach in North Carolina. Nice. How can I move into it? So, a couple of ways. Now, you can move into it anytime you want. The problem is if you're under the age of 59 and a half, you're going to pay tax and a 10% penalty because it will be a taxable distribution. If you're over the age of 59 and it's a pre-tax IRA that owns it, you're going to pay tax on the fair market value of that asset, the home. If you have a Roth IRA and it's been open, or Roth 401k, and it's been open for 5 years and you are over the age of 59 and a half, you can move into that home tax-free. Yes, that asset will now be owned by you personally and will be outside of the Roth IRA, but you can take personal possession of it. And since it's in a Roth IRA or a Roth 401k, there'll be no tax or 10% penalty. So that would be the only way technically you can move into that asset tax-free. I flipped 3 homes this year. Nice. Do you think I should file a 990T for a UBIT? Okay, so this question is about unrelated business taxable income. Generally, it's triggered in 3 ways in a retirement account. Use margin to buy stock or cryptos in an IRA or 401k. Use a non-recourse loan to buy real estate in an IRA. There's an exemption under 514 of the Internal Revenue Code that exempts 401ks from the UBIT tax when they use a non-recourse loan. That is a loan that they do not personally guarantee to buy real estate. Or thirdly, if you engage in an active trade or business like a restaurant through a pass-through entity like an LLC. Corporations like Apple, IBM, Google, Meta, 99.99% of public companies are C Corps. C Corps, think of it as a big box. Box is in that income. Since there's 2 layers of tax, an entity level and a shareholder level, there's no UBIT that applies to the corporate level tax because there already exists a tax. LLCs are pass-through. Think of it as like a funnel. Income just funnels up. Since there's no entity level tax from a federal income tax standpoint, the UBIT tax is imposed at the entity level, and it can travel at 37%. Now, when I say it's imposed at the entity level, it means that they impose a tax, not paid by the corporation, but paid by the, the retirement account. UBIT only applies to retirement accounts and charities. Individuals don't pay UBIT. Now, does flipping 3 homes trigger a business? Probably not. Now, yes, Section 199A under the 2017 Tax Act made it easier for an activity to be treated as a business. There's now a safe harbor that if you satisfy, you'll be deemed a business. But just as easily, you can make sure you don't satisfy it so you're not deemed a business, like keeping separate accounting, tax records, things like that. So 3 homes flipping in a year in a retirement account, probably not going to be deemed a trade or business. 10, probably. What's the idea is that, hey, your flipping activity rises beyond just an investment activity and rises to a trade or business. Much harder threshold than a retirement account. Depends on a number of factors. You can go on our website. There's a bunch of blogs I've written that really covers case law on the subject. Here's a couple items to consider. Number 1, what's your intent? Do you want it to be a business? Number 2, you have employees. Number 3, how close in proximity are the flips? Is it day after day after day? How much you're spending on the improvements, the time you're spending on the improvements, things like that. Those are the elements that go in to determine whether 2, 3, 4, 5, 6 flips a year trigger a business. Clearly 1 or 2 flips or 3 don't, because then almost everyone doing real estate will in some form or fashion would be deemed a business. Obviously, you can trade stocks or cryptos. That's certainly way more passive than real estate, right? All you need to do to buy or sell Bitcoin or stock is just hit buy or sell on your computer. Obviously, real estate, there's more involved, especially if you're doing improvements, renovations, repairs. The argument is that activity could rise to a trade or business. A little bit more difficult on 3, 7, 8 flips in a year. Certainly an argument can be made there's a business, but I think the IRS would have a tough time arguing that. I haven't seen one case actually ever where the IRS argued UBIT in an IRA real estate setting. Seen it with charities. Charities is much easier because with charities, the activity needs to be unrelated to its exempt purpose. So if a hospital has a parking garage or a gift shop, that income would be deemed unrelated. So it would actually be subject to UBIT. That's why a lot of charities will just outsource the parking lot or outsource the gift shop to a third party and just get rent for the space. The rental income would generally be exempted from UBIT, but the sale of the flowers or the parking spaces could trigger UBIT. So I haven't seen any UBIT cases in IRAs, 401ks. I have obviously seen them in the charity setting. They're certainly more common in that area. Okay. Tom, I would argue that you can also trade cryptos held in the exchange for goods or services in just the same way you could if we're held in a cold wallet, withdrawal to a deposit address. Right, but if you own it in an IRA, you can't withdraw it. You're going to need our consent to withdraw it on Gemini. That's the difference. So it's much harder. We have some controls in place for that reason. So yes, I agree with you, Tom. If you own cryptos personally, you can move them off the exchange. But generally, the way our clients are doing it is they're just moving it onto a cold wallet to either hold the asset for more safety or more security, or because they want to do DeFi trading. So we'll unlock the Gemini account, but without our unlocking it, you can't just withdraw it. So even though we unlock it, the problem is after McNulty, by us unlocking the account, you move it onto a cold wallet. At that point, IRA Financial, the chain of custody from IRA Financial to you has been severed, right? Before, once it's on the exchange, IRA Financial still has some custody of it because you still need our consent to get it off the exchange. It's still owned by the IRA. Once we give you that consent and you move it off the exchange, IRA Financial really doesn't have any custody of that asset anymore. And based off McNulty, I think you can run into some issues. But good question. Okay, I own 100% of an IRA and now want to contribute additional funds to pay for improvements, real estate owned by the LLC. Can I do it? Generally, yes. As of today, you're not deemed or your IRA is not deemed a disqualified person. There's language in the new Build Back Better bill that could potentially have an issue with this. But as of today, if you own 100% of an LLC and you have $100,000 in there and you need to add $10,000, I think our compliance allows you to do it. The ownership will remain the same. There's no personal benefit. And you can make an argument under 4975D that any withdrawals you'd be entitled to under D9 because it's an entitlement based off the plan, which basically allows you to receive withdrawals from an IRA investment. So things could change under the Build Back Better bill, which argues that has a provision in there that your IRA is a disqualified person. But now that bill is now hasn't passed. It's dormant. Tom, my reference above was for cryptos held in an IRA LLC. Yeah, I think if you hold it in an IRA LLC, it's a good point. Still, the IRA still technically is the owner of that LLC. But yeah, once you move it off the exchange, you can argue that the chain of command has been broken. If you own it on the exchange, you don't have the control over it, right? The exchange has your keys. Once you move it off the exchange, you have the keys and now you have control. That's the problem. Why are there different rules when it comes to using real estate leverage with an IRA and a 401k? It's a great question. I've talked about this on previous podcasts and videos. Honestly, and you see it in the Build Back Better bill, there is more concern about IRAs because it's owned by individuals than 401ks, which involves pension funds like CalPERS and large state-run pension funds, which are super important to large types of investment funds and investment projects. And that's why you see more legislation and more proposed rules on IRAs and not 401ks. So for that reason, that's where I believe 401ks were given the exemption. Why? Because they want CalPERS, the California pension system, to invest in hedge funds and real estate funds, whereas they don't really care if you or I do it in their IRA. So there's a double standard for 401ks and IRAs. We saw it in the Build Back Better bill, where the accredited investor and the 10% ownership provision only applied to IRAs. It did not apply to 401ks. Any more questions? You advise that for those of us who have cryptos owned by an IRA LLC, where the keys are held in a cold wallet, should move them back to an exchange. I think you should, Tom, right now, until we have a solution with a dual signature wallet. That is my suggestion, Tom. Thank you. Okay, Mr. NC, when I win a lot of tax sale and obtain the deed to the property, is there any issue selling the lot on my own and receiving a check made to the IRA? No, I think if you have it in an IRA LLC, you can transact on behalf of the IRA LLC. Just make sure that the transaction goes back, the cash goes back to the LLC and not you. And obviously you shouldn't take any fees from that transaction. If I need to take a distribution from my IRA LLC, can I just pull the funds from my LLC? No. If you need to take a distribution from LLC, send the money tax-free from your LLC to your IRA, okay, and then fill out a deposit form, a distribution request form on our app, and then we will send you the cash, and this way we can report that distribution on a 1099-R to the IRS, so they have the reporting required, and then you could pay the tax if you need to on your 1040. Okay, everything stays in your IRA. Good. Why is the solution to holding an LLC IRA crypto in a cold wallet? You previously mentioned multi-sig as some form of an option. Yeah, that's coming. The multi-sig will keep IRA Financial's chain of command intact because we'll technically still have some control over the keys. So that's on its way. As a manager of the IRA LLC, can I earn a reasonable management fee? No. 4975C is clear. As a disqualified person, you cannot earn any compensation from the IRA. There's some exemptions if you're a registered investment advisor, things like that. But just as a manager of the LLC, do not take any compensation. Can I roll a SEP IRA into a self-directed IRA or solo K? Yes, you can. No problem. You just cannot roll a Roth IRA into a solo 401k. And here's the last question, since running out of time and getting close to New Year's, and I'm sure people have better things to do than listen to me on and on about self-directed retirement questions. So I think this will be the last one. If I have a pre-tax IRA and a Roth IRA, should I set up two LLCs for real estate investments? Great question. The answer is maybe. It's certainly cleaner to have an IRA LLC for pre-tax IRA and an IRA LLC for Roth. Why? Because especially if you want to focus on certain investments in your Roth that have the potential to generate tax-free growth, so long as the Roth's been open 5 years and you're over the age of 59 and a half, isolating those assets in a separate LLC makes sense. If you aggregated them and combined them, then all you're going to be able to get is a pro rata portion. So for example, you had $100,000 in a pre-tax IRA, $100,000 in a Roth IRA, 200 grand. And you took 100 of that and bought Bitcoin and 100,000 and bought real estate. And now your Bitcoin is up 80% this year. You're over 59 and a half. Roth's been open 5 years. You can pull that out tax-free. You can't just say, I want to pull out the Bitcoin. You have to take pro rata, let's say it's 50-50, 50% of the assets in the LLC you can pull out. That will include your assets from your real estate, for example. So you can't isolate assets. Whereas if you have that in separate LLCs, you can say, okay, I'm just going to pull out the Bitcoin, have that go to the Roth. I don't want to touch the pre-tax. In an LLC, everything goes pro rata. So yeah, you can take the distribution, but it's going to have to go also to your pre-tax IRA, which you may not want to do. So from a distribution standpoint, it's much, much, much cleaner to have separate LLCs. Now you can still combine those LLCs in an investment and have both those LLCs on the title of the real estate. But from a distribution standpoint, if you're getting close to RMD age or you're over 59 and a half and you think you may pull some of that Roth money out, I suggest doing separate LLCs. We'll give you a deal on second LLC, don't worry. But I would do that. I think it's much cleaner. Okay, I guess this is the last question, Karen. Can I open an account in the name of the LLC to open a safe deposit box? Yeah, going back to the safe deposit box thing, you could. The problem is under McNulty, you're still going to have control over that asset. So if you put your cold wallet in there or you put your gold in there, you have the keys, and those keys are constructive control, right? Before McNulty, I guess you can argue that the safe deposit box is physically in the possession, or the gold coins in the safe deposit box, it's physically in the possession of the bank because it's not in your home. But constructively, you still have control over that asset. And the case talks about unfettered command, unfettered control. And you do have unfettered command, and you do have unfettered control if you have the keys to the safe deposit box in your pocket. Whereas if it's held in the depository, you don't. You don't have the keys to that safe in the depository. So that is the distinction, and that's why, based off McNulty, I do not suggest anyone holding a cold wallet in their personal possession. Move the cold wallet, move those cryptos back to the exchange until we have a multi-sig solution ready, and then this way we can present it to you, and this way you can have control over that cold wallet, but IRA Financial will still have command or some custody of that asset directly, which will satisfy McNulty. So not a perfect solution, right? I want to give you, if it was up to me, Karen, it's your money. I'd say yes, do whatever you want, but I don't make the rules. If you want to elect me to Congress, I'll push hard and put me on the Ways and Means Committee. I'll get those rules changed for you. But until that happens, I got as much power as you. So from a IRA custodian standpoint, we need to do what the IRS says. So I agree. No keys, no BTC. I'm with you. No keys, no cheese. I'm with you. I have the same feelings as you do. But it is what it is, right? If you want to own cryptos in a retirement account, we have to comply with the rules. Now, IRA Financial will have a multi-sig requirement, but we'll let you do whatever you want with it. But you're still going to need get our consent. It's not perfect, but at least you'll be able to hold that cold wallet and hopefully sleep at night knowing that you have more security from a hack or an exchange setting a fraud. So not the best solution, but it is what it is. There you go, everyone. Happy, healthy New Year. Thanks for spending some time with me today. I really appreciate it. Lots of fun. I like these mailbags. They're lots of fun. If you have questions, send them in. You can submit them to info@IRAFinancial. Submit them to on YouTube. Subscribe if you haven't. We drop 5 videos, 3 podcasts a week. So you get tons of content on self-directed retirement topics. And we work really hard. I do. I spend a lot of my day on content, thinking about ways to educate all of you on current tax rules in the self-directed retirement world. I'm able to use my law background. There's not many people that have a law degree and a master's in tax law that are able to, that are focused on this area. Lots of smart people I worked with that have law degrees and masters in tax law, but they're all at big law firms and they're not focusing on self-directed retirement accounts. Thank God I found this niche area and I love it. And I've met so many amazing people that have been able to generate so much wealth for their family by taking control of their retirement funds and investing in alternative assets. So it's been a joy for me and I look forward to a great 2022. So happy, healthy New Year and look forward to talking to everyone again next year. Stay safe and stay healthy.